Hello, this is Jeb Hamburger from GoldStockTrades.com. Today is July 7th, 2016, and it's a week that investors are waiting for the jobs numbers that's coming out tomorrow on Friday, and how that may impact U.S. interest rates. Some are concerned that if there's a good jobs number, um, that that could mean that the Fed will raise rates and will hurt precious metals. However, I don't believe the job numbers will be good uh, following last week's Brexit um, exit from Great Britain's exit from the European Union, um, uncertainty with the global banking system, breaking apart of um, the EU economy may signal further countries to secede from the European Union and a sort of spiraling effect. But even before Brexit, let's take a look at gold um, over the past 20 years, the monthly chart on it, because it's really important that we ignore the media and the noise and try to figure out what the chart's trying to tell us here. We could see in the late 90s, pretty much throughout the 90s, throughout the 80s, gold was in a downtrend up until 2001. And this was accelerated by the dot-com bubble and easy money policies. Interest rates were lowered back after the dot-com crash, and it was further exacerbated in the 2008 housing bubble crash, where they had to lower interest rates and throw money into the economy in order to keep it going. That boosted gold to record highs, and we see from 2001 all the way to 2011, we had a marvelous run up to the high 1900 area. And since then, we've been sort of correcting towards the long-term uptrend that we've seen, that it started in 2001 and continues and may continue for a much longer time. As you can see, the rate of increase after the credit crisis was pretty powerful and parabolic. Saw the monthly reversal back in 2011, and we had a significant decline and bear market in gold for the past 5 years. But this year, it appears that the downtrend has been broken, and you don't get in this uptrend. We haven't had many correction opportunities to get in at this low end of the uptrend, along this long uptrend, until the end of 2015, and we had a powerful reversal above that, and now we've broken through a 3-year downtrend, and we may, if we break through $1,400, start challenging the 1,600 area and eventually the 1,900 area into new highs over the next couple of years, or it could accelerate to be the next, over the next year or next 6 months. And this has definitely been the longest correction that we've seen over this past generation. We had a little correction in gold in 2008 during the credit crisis, where it hit almost 1,100 and then dropped down to below 800. But that only lasted several months. This lasted a few years, and has been much drawn out than any corrections that we've seen since the bull market began in 2001. But as you can see here, the long-term uptrend remains intact, and we've bounced off this long-term uptrend and broken through this downtrend, and it could be just the beginning. So we will be following this closely. the next chart that we're going to look at is the long-term chart over the past 20 years on silver. And this is, you can find these charts on finviz.com. But I've done some annotations on here and drawn some trend lines myself. But if you take a look at silver, what you can see here is that in 2010 we had a major breakout and the silver trade went parabolic. It had major basing for 20 plus years, or excuse me, 10 plus years, and we had a major breakout in 2004 and the first run up. But then after we had the correction in 2008, and then we had a phenomenal parabolic move after quantitative easing and the bailouts were announced to $50. And as you can see, that it kind of surpassed the previous highs that it was hitting in the previous rallies. A lot of investors have been recently asking about the breakout in silver, which looks very strong and quite exciting because investors realize how powerful the moves in silver can be, and we witnessed it back in 2010 when we called the silver breakout at $18, and the silver went from $18 to $50 in just a few weeks, but it went parabolic and it over hit our targets because we had targets at 30, and it went $20 above that target. And just how we know that in the markets, the worse things were, and the worse things get, the better they go. Just the same here. The better things were here with silver, and the way that went way overbought and parabolic means the more pain during this 5-year bear market in silver, where it went from $50 back down to its long-term uptrend below $15. But since then, we've had a very powerful breakout here recently. New high, 52-week high breakout, very strong. First major rally. I do think that this 2015 and a 2015 marked a bottom. And we see here what's amazing technical analysis. 30 went 20 points above 30, overbought, and it when it broke down below that overhead resistance line, it went down 20 levels from 35 to 15, and is since beginning to turn above to turning around here bullish. And if you take this line, eventually it could hit this line, upward trend line, in the next few years. That's the way silver is, very volatile. And but again, look at the major breakout we had here in the early part of this decade. I think that this is something that you should really watch silver, because we had a historic bear market, something that we've never seen really before with silver, this long of a downturn. And we had something in 2008 where it went from $22 to $10, during the credit crisis, but then boom, it went higher. So I think that this could also make a powerful move to this uptrend line, and that could be almost a double, more than a double from these current levels. So you got to watch silver, especially when you start seeing this volume increasing, and the shorts beginning to cover here. There's going to be some panic buying here because you're getting a lot of short covering too, and that's the same with gold. I mean, I was on the phone with someone in this recent conversation I had, that now we're seeing that the fear that we've had the past few years in precious metals is beginning to come. There's beginning to become back this fear to optimism and the beginning of a new bull market. So keep a close eye on. And taking a look at copper, since it hit a high in 2011, $4.50. Copper's been in a downtrend, and it's now testing near those levels of $2. Um, and I would feel a lot more comfortable or closely following this downtrend when this gets broken to the upside. But in my opinion, downside you have here is maybe 25 cents, 30 cents. The upside here, the potential could be great once copper breaks out here. But as of yet, even though we've seen increased volume activity in 2016, it hasn't really broken through that $2.50 level. I think if you see it break through $2.50, there's going to be a lot more interest in copper. But right now, it's testing still those 2008 lows below $2 and around $2, which is the lowest it's been, in the past decade. That's some of the lowest prices. So, for contrarian investors, copper might be a good opportunity. If you're momentum and traders, you want to wait to see this downtrend is broken. Taking a look at the NASDAQ, from that credit crisis, we've had a huge rally into the tech stocks. Now we're testing those .com highs, and it's really important as you test these highs in the NASDAQ. These are 16-year. We're going to see if it can break out here. But it's already had a significant rally without any sort of correction since 2009. It'll be quite amazing to see this breakout without a significant correction, because it seems a pretty lofty level. And we can't forget what the .com bubble taught us. There's over the last 100 years, there's been close to 30 major stock market bear markets. So that averages once every 3 to 4 years. Now we've had a rally that's started from 2009 to 2016, so it's going on 7 years, and pretty much straight up. So we're reaching a stage now in this bull market where people are beginning to think this time is different. And because we've had this record run, there's a huge excitement that's getting investors excited about the stock market, and because they think that this is just a risk-free way of making money. But the reality is that bear markets, recessions in the economies, global economy, can still occur, especially now that we've seen with the Brexit. We've seen also the past few years of the bear market in precious metals, which was so strong a few years ago. So as we reach tops, be careful of bear markets. As we get more investors in precious metals, be careful of buying in when it's overbought. Look at moving averages to wait for corrections. This is the first time that I've said in many months and many years that we're beginning to get a little overbought, a little greedy, a little too much euphoria. So don't get carried away. That's it for today, folks. Be careful of getting too carried away with overbought conditions. Wait for pullbacks. Be patient. Stay smart. And I will be continuing to update and follow the markets as these job numbers are reported. Have a great day. Again, it's Jeb Hamwerger, goldstocktrades.com.